Hello everyone. The month of Feb was actually a very mixed bag as far as the bond markets were concerned. For starters, the budget day event actually invoked a lot of fear given the fact that there was a massive gross borrowing program announcement of the government securities on the back of a higher than expected fiscal deficit. Soon to follow, obviously, was the monetary policy event in early February, which brought in a little bit of cheer. I would say loads of cheer, given the fact that the budget day event had actually spooked the sentiments for the bond markets. What followed was a gyrating bond market through the month. However, bond markets, the yields across the curve marginally eased in some segments and remained flat in most of the segments. But I think the key to note was obviously towards the end of the month, the geopolitical event which actually occurred between Russia and Ukraine, which actually spooked the sentiments across the world. And as we ended the month, while we ended the yields on a flat note, the sentiment continued to remain downbeat. The key question therefore is what lies ahead for bond markets going forward? Well, the way to answer it is twofold. A, what is the likely impact of inflation? We are seeing global, specifically the US inflation looking reasonably high at a 40-year high of almost 7.5%. So much so that the real rates in the US are in the negative territory. Flip it to India, the headline inflation, which is the CPI, still continues to remain within the RBI tolerance band, though the core inflation is sticky at 6%. However, the central banker actually looks at the headline number for a monetary policy decision making. The delivery of the minutes, including the decision on the policy day, both seem to be visibly dovish. No imminent signs, we believe, of a threat of a benchmark rate hike in the offing. There is a normalization of liquidity already underway, so much so that the short end of the yield curve has reasonably inched up and is trying to mimic the repo rate to a larger extent rather than the reverse repo rate to a lesser extent. I think that process will continue for some more time, and of course, the mother of all events, the first ever rate hike by the Federal Reserve in the US, which is slated for March, will be a keenly watched out event. Will the warlike scenario currently sap the sentiments and dissuade the US Federal Reserve to not go very aggressive on rate hikes? I think some of these pointers will shape the monetary policy decision making for India, obviously when they meet in the month of April. But for now, I think all eyes on how the geopolitics pan out, how the other world central bankers behave, how the currency behaves. It is quite evident that the Russian ruble is under pressure, and so are most of the emerging currencies as dollar gains strength in this kind of an uncertain scenario. The Reserve Bank of India, to our mind, will leave no stone unturned to ensure that there is an orderly evolution of the yield curve. Going into the next financial year, there is a fear of huge supply hitting the bond markets, which is not really letting yields come down on a durable basis. We believe, as appropriate and when required, the Reserve Bank of India will conduct open market bond purchases stroke Operation Twist, wherein they buy long-term bonds and sell short-term bonds to ensure there is a reasonable anchor at the long end of the yield curve, and also, most importantly, ensure a smooth passage of the borrowing program. What should you do as a bond investor? A, the yield curve is discounting very aggressive rate hikes. When we look at the OIS or the swap curve, the 2-year OIS curve is suggesting a likelihood of 125 basis points rate hike over the next 1.5 years. If you look at the short end of the yield curve, it has already discounted rate hikes as early starting April, then going into June and in August. The steepness of the yield curve is one of the highest ever that we have seen. All this is pointing out to the fact that bulk of the negative news is predominantly discounted in the bond prices as we speak. So while volatility is likely to continue for some more time, we believe for fixed income investors, earning the carry is the most important order of the day as far as CY22 is concerned. So strategies like floating rate funds, like dynamic bond funds, target date maturity funds, which allow you to A, mitigate interest rate risk to the extent possible, and I call them the Zor Ka Jhatka Dheere Se categories, which are low to moderate on duration, could well be the way forward for bond investors. Keep volatility at bay, keep your portfolio asset allocation and objective pretty handy when you are taking investment decisions. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.